Today, we're doing a complete breakdown of Indian Accounting Standard 113. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine two companies valuing identical assets wildly differently, causing investor confusion. Before Indian Accounting Standard 113, this was reality. Now, a $10 million asset is consistently valued the same way across the board. You'll learn how Indian Accounting Standard 113 standardized fair value measurements, bringing clarity and comparability to financial statements. Indian Accounting Standard 113 was born out of the need for consistency. Before it, companies could interpret fair value differently, resulting in confusion and lack of transparency in financial statements. By standardizing fair value, it provides a consistent approach, ensuring that a $5 million asset is valued similarly across industries, aiding investor clarity and comparability. Entities following Indian Accounting Standard since April 2013 must adopt Indian Accounting Standard 113 to align with global practices. The standard's linchpin is the fair value hierarchy, classifying inputs into three levels, level 1 being highest. Your cash flows, for example, can fall into level 2 or 3. This hierarchy ensures consistent asset valuation, aiding transparent disclosures. The fair value measurement model under Indian Accounting Standard 113 is about determining the price you'd get selling an asset in a normal market. Imagine selling a $2 million building. Its value is aligned with market data, not internal numbers. Prioritizing observable inputs ensures realistic valuations, crucial for finance professionals discussing asset valuation in interviews. Scope is a critical element of Indian Accounting Standard 113. Candidates often mistakenly think leases are covered, which is a classic interview pitfall. Understanding where this standard applies can be the difference between accurate valuation and costly errors. Knowing the scope helps in correctly implementing fair value measurements across financial statements, ensuring compliance and accuracy. Indian Accounting Standard 113 applies to various items ensuring accurate market valuation. Financial instruments such as derivatives need fair value measurement to reflect trading prices. Investment properties must fairly present their market worth. Biological assets like cattle are valued at market prices, while non-financial liabilities arising from mergers need fair value for accurate financial reporting. Certain items are explicitly excluded from Indian Accounting Standard 113, which often trips up candidates. For example, share-based payments follow Indian Accounting Standard 102, while leases are under Indian Accounting Standard 116. Understanding inventory valuation under Indian Accounting Standard 2 and deferred tax treatment in Indian Accounting Standard 12 is essential for accurate financial reporting. These exclusions ensure that each standard's unique requirements are properly applied. Fair value represents the transaction price between willing market participants. It's the price at which an asset could be sold or a liability transferred under current market conditions. For instance, imagine selling a machine. Fair value would reflect its sale price today, not what you paid for it. This market-based approach ensures financial statements align with real-world economic conditions, enhancing reliability and comparability. Market participants are crucial to determining fair value, ensuring transactions occur under normal market conditions. These independent, informed parties transact willingly, reflecting true market dynamics. For instance, consider two firms discussing a merger. Their negotiations set a fair value for net assets, not distorted by financial distress. This concept ensures financial statements reflect realistic valuation, vital for investors and stakeholders. Scope edge cases often trip up candidates. Leases, even when modified, fall under Indian Accounting Standard 116, not 113. Share-based liabilities follow Indian Accounting Standard 102, not fair value. Inventory valuation remains within Indian Accounting Standard 2, focusing on cost, not market price. Pension liabilities aren't measured at fair value, highlighting the importance of understanding these distinctions to avoid costly errors in financial reporting. Ever wondered how companies consistently value assets in financial statements? The fair value measurement model in Indian Accounting Standard 113 provides a structured approach. It ensures assets like Meridian Corporation's $10 million SaaS contract are valued fairly, reflecting true market conditions. This model is crucial for transparency, making financial reports reliable for investors and stakeholders. The fair value measurement model guides companies in valuing assets like Meridian Corporation's SaaS contract. This model outlines a clear 5-step process, ensuring valuations are consistent and align with market conditions. Starting with determining the asset type, it moves through identifying the right market, selecting a valuation technique, gathering inputs, and finally, measuring fair value. Follow Meridian's $10 million contract journey to understand each step. Meridian Corporation must first determine what exactly they're valuing in their $10 million SaaS contract. This includes identifying the $8 million software license and the $2 million implementation services as separate components. Failing to distinguish these could lead to misvaluation. Indian Accounting Standard 113 emphasizes separating assets with distinct characteristics, ensuring each component's value is accurately represented. By identifying these, Meridian sets the stage for precise measurement, crucial for subsequent steps. Next, Meridian Corporation needs to identify the primary market for their contract components. The $8 million software and $2 million services might trade in different markets. Recognizing this is crucial, as using the wrong market could distort fair value. Indian Accounting Standard 113 requires using the principal market offering the most observable inputs. By selecting the correct market, Meridian ensures their valuation reflects real-world conditions, vital for the next steps. Now, Meridian Corporation must select how to value their assets. The $8 million software might use a cost approach, while the $2 million services could benefit from an income approach. Choosing methods based on data availability ensures accuracy. Indian Accounting Standard 113 advises maximizing observable inputs, reducing reliance on estimates. This careful selection confirms that Meridian's valuation aligns with reality, preparing them for input gathering in the following step. Meridian Corporation is now tasked with gathering specific data for their valuation techniques. Market prices for the $8 million software and revenue forecasts for the $2 million services are essential. Using outdated data leads to inaccuracies, so Indian Accounting Standard 113 stresses observable market inputs. By securing reliable inputs, Meridian ensures their valuation mirrors true market conditions, setting them up for an accurate fair value measurement in the final step. Finally, Meridian Corporation combines their chosen techniques with gathered inputs to calculate fair value. Using the cost approach for the $8 million software and income approach for the $2 million services ensures precision. Indian Accounting Standard 113 demands consistency in application, safeguarding against errors. This process results in a robust, market-aligned valuation, reflecting the true worth of Meridian's contract and completing the fair value journey with clarity and accuracy. Choosing the right measurement method can drastically alter your financial picture. Imagine overvaluing assets by $10 million due to an incorrect method. Indian Accounting Standard 113 provides the framework to ensure accuracy, requiring specific disclosures to maintain transparency and investor confidence. Let's explore how these decisions impact real financial reporting. Initial recognition under Indian Accounting Standard 113 is crucial as it sets the baseline for future measurements. Assets must be recognized at fair value, guided by an exit price concept. Imagine acquiring machinery that costs $5 million. If the market price drops to $4 million, your books should reflect this fair value, ensuring stakeholders are informed accurately. This process involves using observable inputs and considering whether the transaction occurred in an orderly market, preventing distorted financials. Subsequent measurement means revisiting fair value at each reporting date. You're not just locking in a number, you're ensuring your balance sheet reflects reality. Suppose an investment property initially valued at $10 million now sees a market dip to $8 million. Recognizing this change in fair value ensures transparency. Depending on the asset's classification, these changes impact either the profit and loss or other comprehensive income, maintaining the integrity of financial reporting. How fair value measurements appear on financial statements directly affects stakeholder interpretation. Consider investment properties on the balance sheet. the notes should lay out valuation techniques, providing a roadmap for investors. Assets are classified into level 1, 2, or 3 inputs, clarifying the reliability of measurements. These disclosures affect key metrics like net income, guiding everything from investor decisions to executive bonuses. Clear presentation is non-negotiable for accurate financial analysis. Disclosures under Indian Accounting Standard 113 aren't just numbers, they tell a story of accuracy and foresight. Revealing the fair value hierarchy level shows how reliable your asset measurements are. Detailing valuation techniques and any changes enhances credibility. Analysts rely on quantitative data about unobservable inputs to assess risk. Sensitivity analysis, particularly for level 3 inputs, offers a view into potential value swings. These disclosures ensure stakeholders see a comprehensive, honest financial picture. Imagine a CFO managing a $15 million property investment. Using market comparables, it's initially recognized at fair value. Each quarter, the CFO revisits market data, adjusting the balance sheet to reflect a new value of $13 million. By disclosing it as a level 2 input, the CFO relies on observable market data. Sensitivity analysis indicates a potential $1.3 million drop if markets fall by 10%. This hands-on approach ensures strategic, informed financial management, directly under Indian Accounting Standard 113 principles. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. When Meridian Corporation signs the lease, Indian Accounting Standard 113 mandates recognizing both a right-of-use asset and a corresponding lease liability. This ensures the financial statements reflect the economic reality of the asset under Meridian's control and the obligation to make future lease payments. The $1,200,000 reflects the present value of lease payments, impacting both the balance sheet with asset recognition and liability acknowledgement. The lease payment reduces the liability on the balance sheet. However, not all payment reduces the principal. Part of it covers interest expense, which is a cost of financing. As per Indian Accounting Standard, interest expense of $60,000 is recognized, which increases the company's interest expense in the income statement and effectively shows the borrowing cost Meridian incurs during the lease term. To accurately portray asset usage, Indian Accounting Standard requires annual depreciation of the right-of-use asset. For Meridian, the $240,000 depreciation expense spreads the cost of the asset over its useful life, impacting the income statement by reducing profits. Accumulated depreciation on the balance sheet reflects the asset's diminishing value, aligning with Meridian's resource consumption. Indian Accounting Standard 113 requires a reassessment when lease terms change, impacting the financial position. Meridian reduces its liability and the right-of-use asset by $50,000 after renegotiating terms. This adjustment reflects the updated expected cash flows and assets utility, ensuring accurate financial statement representation and aligning with the revised economic obligation and asset value. Interest accrual ensures that all financial obligations are accurately reflected in Meridian's year-end accounts. By recognizing accrued interest of $50,000, the company captures the cost of financing inherent in the lease agreement. This action aligns with Indian Accounting Standard guidance, ensuring liabilities reflect up-to-date borrowing costs, presenting a comprehensive view of financial commitments in Meridian's balance sheet and income statement. Upon lease completion, Meridian must de-recognize the right-of-use asset and corresponding liability. The $860,000 adjustment reflects the full settlement of obligations and removal of the asset from the balance sheet. This action marks the completion of the lease lifecycle, ensuring the financial statements no longer carry any remaining lease-related balances, providing a clear and updated view of Meridian's assets and liabilities. Every Big Four and investment bank interview on Indian Accounting Standard 113 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Fair value is the price to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. It's market-based, not entity-specific. Understanding the market participant perspective is key. Avoid confusing it with carrying amount. Fair value reflects current market conditions. Memorize that fair value aligns with market realities, not company-specific situations. Indian Accounting Standard 113 was introduced to provide a consistent framework for measuring fair value and enhanced disclosures regarding fair value measurements. It aims to standardize how fair value is determined and reported across different entities, improving comparability. A common mistake is overlooking the importance of standardization. Remember that Indian Accounting Standard 113 bridges gaps in fair value reporting. Changes in fair value are recorded in profit or loss or other comprehensive income, depending on asset classification under Indian Accounting Standard 113. Companies must ensure correct categorization to avoid misstatements. A common mistake is misapplying valuation techniques. Understand that consistent application of these techniques is crucial for accurate financial reporting. Memorize that proper classification dictates where changes appear in financial statements. Indian Accounting Standard 113 and International Financial Reporting Standards 13 are largely aligned, but there are nuances in disclosure requirements and terminology. One difference is in the level of detail required for disclosures. Often, candidates ignore these subtleties. The takeaway is to understand that while conceptually similar, tiny differences can affect financial statement presentation, especially concerning disclosures. Fair value is directly affected by market conditions, reflecting current market realities. Volatile markets can cause significant fluctuations in reported values. A common error is ignoring market participant perspective, which can skew valuations. Always consider market dynamics when calculating fair value. Memorize that fair value should represent an exit price under current conditions. Indian Accounting Standard 113 permits 3 valuation techniques: market, income, and cost approaches. Companies must apply the method that best reflects market conditions. A frequent mistake is misapplying these techniques. Each method provides a unique perspective, so understand application contexts. Memorize that consistent and appropriate method use is key to reliable fair value measurement. Indian Accounting Standard 113's fair value hierarchy includes 3 levels, prioritizing observable inputs. Level 1 uses quoted prices. Level 2 involves similar observable inputs, and Level 3 relies on unobservable inputs. The main trap is confusing the hierarchy's order. Remember, higher transparency and reliability are at Level 1 and decrease through to Level 3. Indian Accounting Standard 113 excludes share-based payment transactions and leasing transactions. This exclusion often confuses candidates who assume all fair value measurements are covered. Recognizing scope limitations prevents misapplication. Remember, the standard addresses fair value measurements for financial reporting, but not for all transactions, ensuring clarity in its application scope. A CFO must disclose the valuation techniques and inputs used, the reasons for changes in techniques, and the effect of fair value measurements on profit or loss. Many overlook the detail required in disclosures. Key takeaway: detailed and transparent disclosures enhance reliability and comparability in financial statements, providing greater insight to stakeholders. Fair value and carrying amount are not synonymous. Fair value reflects current market conditions, while carrying amount is the asset's recorded value on the balance sheet. Candidates often mix these up, leading to errors in financial analysis. Always differentiate them. Fair value is market-derived. Carrying amount is accounting record-based. Mastering the basics of Indian Accounting Standard 113 starts with understanding its objective to streamline fair value measurement across standards. It applies whenever another Indian accounting standard references fair value. Key definitions include fair value itself as the price obtained in a transaction, and the concept of orderly transactions, which presupposes market exposure. It identifies market participants as independent and knowledgeable, focusing on principal and most advantageous markets for accurate valuation. Indian Accounting Standard 113's core model revolves around achieving fair value by assuming an exit price in the principal market. It stresses the importance of using the highest and best use concept to maximize asset value. The standard distinguishes between observable inputs, like market data, and unobservable inputs, such as internal assumptions. Level 1 inputs are critical, comprising quoted prices in active markets. The standard endorses market and income approaches for precise fair value measurement. Preparing for an interview on Indian Accounting Standard 113 requires pinpointing potential traps, such as confusing the principal and most advantageous markets. Although it aligns closely with international financial reporting standards, minor terminology differences exist. Understanding disclosure essentials is key, especially fair value hierarchy levels and techniques. For non-financial assets, the emphasis should be on highest and best use. Familiarity with the fair value hierarchy and how valuation techniques are chosen is vital, including disclosing input sensitivity impacts. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.